The broadcast is now starting. All attendees are in listen-only mode.
All right, everybody. Mike Lieberman here with Dr. Charles Lieberman, Chief Investment Officer of Advisors Capital Management. As you know, we obviously just sent this notification out now, putting together a webinar fairly quickly about the contagion of Silicon Valley Bank, regional bank volatility in general. Obviously, for anybody who's a financial advisor, you know we are dealing with what feels like, or an investment advisor, right? You know we are dealing with what feels like a fire right now. And so obviously we want to give you, everyone the tools, questions, whatnot to be a firefighter. With that, go ahead and feel free to ask questions in the text box. We will try to answer them in real time. We're going to try and keep this webinar to a half hour. Sure, everybody has issues they want to get back to. Otherwise, we'll have more webinars about this subject if it continues to be as large scale as it currently is. Otherwise, probably in the 10-second interview show is where we'll get our thoughts out. So, Chuck, thank you for being on the call. Let's get into it fairly quickly. I put these slides together, again, also fairly quickly. Silicon Valley Bank collapses end of last week. I feel very comfortable in saying nobody saw it coming. Very few people saw it coming. First, can you explain what fractional banking is, right? And how it is that all banks operate in this capacity.
Well, when you deposit money in a bank, the bank doesn't just sit on it. It's paying you interest, a small amount, a large amount, whatever it is, and they've got to earn something on the deposit in order to be able to pay that interest. Typically, banks have, ballpark of several percent of the deposits held as capital, and all of the rest is loaned out in one form or another.
So loaned out, right? But for the excess capital, right, which is what happened with Silicon Valley, they took in a lot of capital. They then have to invest it in two different ways, right? One they can consider available for sale, and one they consider as a held to maturity asset. Why do they have to pick one or the other? And what is a held to maturity asset? Because this is eventually what took down Silicon Valley.
Exactly. So think of the simplest way to think of it is, imagine a bank takes in $100 and they go out and they buy $90 worth of bonds, government bonds, so they're avoiding any risk of default, and they're earning interest on that bond portfolio, and that gives them the income to pay their operating expenses and also interest on deposits. The regulations allow them to separate that portfolio into two pieces. One, mark to market. And mark to market means that as the value of the bonds fluctuate, the gains or losses flow right through the income statement. So you buy a bond at par, goes down to 90, you lost $10. And that shows up as a decline in profitability. Obviously, banks don't want to do a lot of that because it makes their profit statement fluctuate wildly at times. And so what they really want to do is act as longer-term intermediaries. They take in deposits, they lend out, buy bonds, and they want to hold those bonds to maturity. So you buy a bond today at 100. Let's say it's a 5-year bond. In 5 years, you're going to get 100 back, and you want to take the interest income as income every year, offset by the interest you pay out, and you're earning the spread. And that's why a lot of banks are called spread institutions. The held to maturity book is that spread business. However, if you're a large bank, you do not have the option of holding large held to maturity assets because the value can fall a lot. The Fed doesn't give them that ability. And so they are forced, they're required to market every single quarter. So they have more volatility in their profits and therefore have less interest in holding a large investment portfolio in securities because it causes a lot of volatility in their returns. If you're a smaller bank, meaning anything outside, the top half dozen or 10 banks, you are allowed to hold held to maturity. But if you've not taken a stupid pill, and I think Silicon Valley did take a stupid pill, then you want to make sure that you're not just buying long-term bonds, which fluctuate enormously in value, and you're financing that with overnight money or short-term money, namely deposits, because then even though you don't report the losses in your income statement, you're still nevertheless suffering losses. Imagine the worst case scenario. You buy a treasury bond a year and a half, 2 years ago, you earn 1% on your 10-year, and you're now forced to pay 3 or 4% on your deposit. You're losing money, and the value of the bond has fallen dramatically. Silicon Valley did some version of precisely that. Their average maturity on their portfolio was too long, and they were probably still making money looking at the income coming in from those bonds relative to the interest rate that they're paying on deposits. Nonetheless, the value of the portfolio had declined a lot. And what was really egregious here was most of their portfolio in bonds was quite substantial. They had approximately $91 billion in the held to maturity securities portfolio. And that's out of a total asset base of a little over 210 billion. So not quite 50% of their entire portfolio, of their entire book of business, all of their assets was held in the held to maturity portfolio. And that's why investors got scared, pulled their money, word spread like wildfire, and put them in a deep hole.
Okay, so you have this digital, for the first time ever, probably a digital bank run, where, as you know, people are aware, and obviously we have questions coming in now about this, but assets started to flood out incredibly, right? The bank lost something like $42 billion in 24 hours. So, you know, and a lot of at least the reporting at the time was that the outflow of assets was faster than the sales process could even be. So it was very difficult for anyone to step into this and buy the bank because assets were leaving so quickly. Now, again, moving on, I want to try and keep this to, you know, the next 20 minutes.
And one more critical point here, which is that its depositors, Silicon Valley's depositors, were mostly institutions. Individuals know that they've got insurance on their deposits, and they're pretty much immune to fluctuations at the bank. In the case of Silicon Valley, that was not true. Most of their deposits were from institutions. And as a result, those institutions knew they did not have insurance coverage. And that's why the deposits were fleeing so quickly. Most other banks, in fact, very few other banks are seeing anything like what Silicon Valley has seen in terms of money flowing out.
Now, and quickly, sort of my own opinion, very quickly, and my thoughts on it, you know, it doesn't make a lot of sense to me that if I have $2.5 million in cash in the bank, I'm only insured to $250,000. Yet, if I have $250,000 in 10 banks, then I'm insured for all of it. So there seems to be something, you know, which they're clearly going to address in terms of insurance coverage. However, like you said, there aren't a lot of banks that had as many business accounts as Silicon Valley. However, the West Coast banks of this country are fluctuating like crazy, right? That fear of bank runs, that genie is way out of the bottle. And you are seeing volatility in stock prices of West Coast banks, that being PacWest, that being Western Alliance, that being First Republic, right? You are seeing absolute, you know, volatility through the roof in terms of stock prices.
That's exactly why the Fed has announced that it's insuring, or no depositor will lose a dime, because by doing that, they can stem the outflow from all of these banks. Not even the large institutional clients of Silicon Valley are supposedly going to lose a dime. The Fed is going to make sure that they can get all of their money. So that will work.
All right, so they have so the government stepped in here, right? Contrary, you know, to 2008, they clearly are doing a couple things differently. One, they're moving very, very quickly, and two, they seem to be hitting the resources they can that do not need congressional approval, allowing them to operate fast. So they created something called the Bank Term Funding Program, In layman's terms, right? What is that?
That's basically just like the discount window. So a bank can go to the bank term funding program, they can borrow money, they can post assets as collateral, and therefore they can have the cash to basically cover any deposit withdrawal.
Overall banking system, right? Is it sound? Is this 2008 all over again?
Nothing like 2008. 2008 had a number of problems, none of which are similar to today. The worst part about it was, I think, the way the government handled it then versus the way the government is handling it now. Paulson actually increased the fear level of banks by saying he was going to do nothing to bail out the banks. And they forced Bear Stearns to get acquired by JP Morgan, but the process scared the hell out of a lot of investors because you knew that if there was a problem at an institution, the government would not bail you out in any way, shape, or form. And the term bailing out was also pejorative and made it even worse. This time around, the government is saying, look, they're not bailing out the banks, but they're bailing out all of the depositors. No depositor is going to be harmed. And therefore, no depositor needs to pull their money because the government is backstopping that. And that, of course, will keep the banks intact.
Okay, so now, right, let's talk, and there's a lot of questions coming in here. Okay, so one, we're going to get into what the Fed's going to do next. Two, why do you think they had to create a separate program instead of using the discount window? Why didn't they just use the discount window?
I think that's a technical or legal question. In my mind, they certainly could have. There are a lot of institutions that have assets that they easily could have taken to the discount window. But one certainly technical aspect of it that required something different was when you take an asset to the discount window, the value of that asset is valued at market. So if you bought a bond at par, it's worth 80, and you take it to the Fed will apply a haircut to the value of 80, and they might lend you 70. And so you can't borrow enough to fill up any hole that you've suffered in your capital as a result of the decline in market value of your assets. But under the Bank Term Funding Program, if you bought a bond at par, it's now worth 80, you can borrow par. And therefore, you have a much greater ability to literally fund any withdrawals that you see. So I think that's probably the single most important factor here.
All right, so the banking system you would say is sound. Let's look forward, right? The Fed, a lot of people would say the Fed is going to break something. The Fed is going to break something. Raising interest rates is too fast is a concern. And again, to put this in context, when Silicon Valley bought their long duration assets in their held to maturity book, this was they made these investments in 2021, 2020. Even at that time, the Fed was projecting interest rates would be 0 in 2024. So it's not like Silicon Bank went into this and was offsides out of the gate, right? They got caught offsides later when interest rates exploded, but these were in the held to maturity book. They weren't allowed to make adjustments to the current holdings. So they weren't always offsides here out of the gate. It only happened once, obviously, inflation went through. So you have the conversation here, the Fed raising rates this quickly is going to break something. Okay, something broke.
I want to push back first.
Go.
So if you're managing the investment portfolio of Silicon Valley Bank, you should not be buying long-term bonds at 1% because, you might expect interest rates to stay low. The Fed said it was expecting interest rates to stay low. But your job as a risk manager is to consider that at some point interest rates are likely to go up.
Yep.
And that portfolio is going to get crushed in value if that happens. The simple way to protect yourself is just buy shorter maturity assets. Don't buy the 10-year, don't buy the 30-year, don't buy the 5-year. Buy 1-year T-bills, 6-month T-bills. Yes, you get a lot less interest. You go back a year or two ago, interest rates on those kind of securities were close to zero, and you're paying close to zero on deposits.
Okay.
So what? You're not making a lot of money. But
so is the held to maturity book of other financial institutions available to the public, right? How do we know? Do you know? Can you look at the balance sheet and say, hey, nobody else has the same problem? Or can you say, wait a sec, there's other banks here that have got problems?
The banks do report the held to maturity book versus held for sale. In the case of, for example, of First Republic, their held to maturity book is $28.3 billion. Their held for sale is 3.3. These are all figures as of 12/31/22. And First Republic is about the same size as Silicon Valley. So their held to maturity book is less than a third the size of Silicon Valley's book. So there's a what Silicon Valley did is really way beyond what most other institutions have done. In fact, I'm not sure there's any institution that has done anything like what Silicon Valley did. So I don't know if it's unique. There are 6,000 banks in the country. I haven't gone through the balance sheet of all of them, but I can tell you that what they did is extraordinary.
Okay, Fed going forward, is this a shock to the system? It's a clear shock to the system. One,
Right.
Does the Fed stop? Two, do they reassess what they're doing? Is this a pivot type moment? What does the Fed do here?
I think the Fed probably does stop. They don't have to make that decision today. Their meeting isn't until next week. And so they have several days in which to see whether or not the markets calm down, whether the banking system, the bank stocks rebound, and they can try to see whether or not the economy reacts to what's going on. My guess is that the Fed keeps policy unchanged. Why add more risk to the system at this point in time? Why not allow data to come in over the course of the next several weeks until the next FOMC meeting and see how the market has responded, how the economy has responded? So my best guess is the Fed leaves policy unchanged. By the way, I would give a lot of blame to the regulators here. The regulators knew what Silicon Valley's portfolio looked like. They should have understood the risks that were being taken, and yet they didn't do anything to force Silicon Valley to reduce its exposure to the bond market, to hedge some of that interest rate risk. Things could have been done to protect that bank, and they weren't. Management failed, but I think the regulators also failed. And now the Fed is dealing with the situation. My guess is that, again, they do nothing next week. They allow things to calm down. And I suspect things will calm down fairly quickly because I don't think we're going to see other bank failures like Silicon Bank.
So volatility, yes, to summarize. Volatility, yes. Contagion, not in a significant way. Fed slows down or stops this time around and then starts to look at this. All right, so more questions coming in.
While you're looking at them, let me reinforce the point about contagion. Everything the Fed has done this time, unlike 2008, has been to contain contagion. That was Paulson's failure in 2008. He did not do anything to stop contagion. In fact, he promoted it. Unintentionally, but nonetheless, he promoted it. This time around, the Fed is doing precisely what it needs to do to prevent contagion. If you're a depositor at, any bank in the country, you have reason to believe today that your deposit is safe, not just up to 250,000, up to 25 million, 250 million. So you have no reason to pull your money out of the bank, and therefore that stems the turmoil.
Okay, now let's focus on the banks in general. Assuming right in this past weekend there was an incredible flow of dollars from regional banks to the Big Four or the Big 10, let's just say, the ones that are too big to fail. Right, because there's just more, you know that a JP Morgan is going to be, you know, come hell or high water, the government's not letting that go. You know, let's just say the Big Ten, like I said. How can a regional bank or a local bank get depositors to stay? My thought is that they would have to pay higher levels of interest on cash, right? Or at least to prevent investors not only from going to another bank, but from going to a money market fund or going to treasuries, right? So, you know, can a smaller bank that does not offer the same, you know, perceived security as JP Morgan continue to get by without offering higher levels of interest at this point? Or are they looking at just deposit deterioration because people are going to go to where the money is, where the safety is?
Well, in the very short run, the most nervous depositors may pull their money out of a small regional bank or a community bank. That's possible. In fact, I would even say it's likely. But you just had the Fed tell you that all deposits are now insured. You really have no reason to do that anymore. You know, some people still do things that are foolish because they get scared easily. So some of that money is still going to go to, you know, the JP Morgans of the world, sure. But I think that that's going to peter out pretty quickly.
Won't deposits go to money market funds? Why would you stay at a bank yielding zero, you know, when you've got to deal with this, the heartache, the stress,
yeah,
or whatever?
Yeah, but if money goes to a money market fund, the money market fund's got to do something with that cash, right? And one thing they might do, by the way, is buy a negotiable CD from a bank. And so they're putting the money back into the financial system. It doesn't necessarily go to the same banks. Maybe they buy CD, you know, the local bank loses the deposit, it goes into a money fund, and the money fund buys a bank CD, a negotiable CD from JP Morgan. And then JP Morgan turns around and lends that money to the local bank, or the local bank takes its assets, goes to the Fed and borrows there. So there's nothing that breaks the local bank as long as deposits are guaranteed, at least in my judgment. Longer term, the competitive position of smaller banks might erode. Obviously, the big banks offer more safety. The Fed is not going to be happy with that outcome because they don't want the banking system to become ever more concentrated. And so they're going to have to do something to help smaller banks compete.
Okay. So at the very least, you know, it doesn't sound like, right, at least that we know of so far, Silicon Valley broke any laws. They were just hedged stupidly, incorrectly, and regulators, you know, did not catch it. That's the initial, right, rock in the water, and then the ripples from there. You're expecting, you know, again, we're going to summarize, we're going to wrap up here, but you're expecting this scenario to essentially start to calm down as opposed to escalate further.
Yeah, and I don't think it's going to take a long time to calm down either. My guess is it'll happen within a couple of days. The stock market overall is up a bit today. The banks are still down. People are still nervous about the banks. We're looking at the money center banks as buying opportunities.
There's a note here, insured no matter how many. Well, you're insured, for anyone who's questioning it, you're insured $250,000. That is the FDIC insurance level, $250,000.
Right.
Per account, per bank.
And that's why the institutional depositors at Silicon Valley Bank were in such trouble, because typical account of an institution, of a commercial firm, is much, much larger than that. And so they had very little insurance coverage, and that's why they pulled money out as fast as they could. And the Fed is now acting to try to encourage them to stay because they're insured now too.
I take it back, not per account, per depositor. Okay, so you think this calms down? You think this is not like 2008? Clearly, though, the pain from 2008, you know, makes people feel like it's that again. You think the government acted appropriately here, fairly quickly, and hopefully this scenario dies down, and we can focus on whatever comes next.
Yeah.
With that, right, I'm going to go ahead and wrap things up. We will have replays if you want to pass this out. Also, we will post it to our website, advisorscapital.com. If you want to go ahead and see there, we hope that we can at least offer some sort of intellectual capital during periods of heightened volatility when everybody's got questions and clients are concerned. With that, there's our email address. If you want to follow us on LinkedIn, you want to follow us on Twitter, there are the QR codes. Stay in touch with us. We will stay in touch with you. Hopefully more from us as news continues to break. Thanks, everyone, for being on the call.